In this episode, we talk about how to identify and recover from a financial mistake. Let's get started.
Let's get some money. From New Money, New Problems, it's the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. Negotiating compensation, purchasing your first investment property, helping your family with money, the highs and lows of entrepreneurship. New money brings new problems that require new solutions. Join us as we work through them together. I'm Brenton Harrison, and this is the New Money, New Problems podcast.
Hello and welcome to this week's episode. If you are like me and people in the South, this may be your last week of summer break. My family and I just got back from a couple days on 30A down in Florida. And over the next couple of weeks, we will pepper in some content on back to school finances. But this week, I wanted to expound upon an article in which I was recently featured from NerdWallet entitled, and I quote, "Asked on Reddit, how do I recover from a big money mistake?" If you're looking on screen, you can see that article on the screen. We will put a link to it in the show notes. And it reminded me of a podcast episode, which we will also link to in the show notes, that we did a while back, where we covered my biggest financial mistakes. And I went chapter and verse through some of the biggest things that caused me pain and heartache financially. And in the article on NerdWallet, I shared how to recover those financial mistakes. And I wanted to give you a little more context than I was able to share in the few quotes that I shared with the author. So we're going to go through all these processes, starting with when you would determine whether something is a financial mistake in the first place. And this is more about time horizon for evaluating an investment opportunity. And we come to this very frequently in our work where we have someone where we've either made an investment recommendation, an investment management recommendation, or they bring an investment recommendation to us. And it's not as much about finding the date as it is about finding the date that's too soon to evaluate the investment. What I mean by that is, for example, with an investment recommendation or an investment manager, it is highly likely that a person is going to look back after the first year and want to make some decisions if it did not perform up to their expectations. When in reality, whether it's an index fund, an ETF, a stock, an investment manager, a year is simply not long enough to determine whether it's just a blip in the road or whether there's a strong indicator that there's something wrong with what you've chosen. For example, with a single stock, it may be a company that's well positioned for the future, but they just had a bad product rollout, or they were adversely impacted by the tariff conversation. With real estate, it depends on why you bought the real estate, but we have people who often try to evaluate a property too soon. Now, if you're trying to buy and flip a property, then maybe after a year or 2 years, there is the opportunity to look back and say this was or was not a mistake. But if you're buying something that's intended to be a long-term buy and hold property, maybe as rental real estate, and you're upset because it hasn't turned a profit in the first 6 months or the first 9 months or the first 18 months, you have to determine going into the process what your time horizon is for evaluating whether it's just truly you being a little jumpy or if it's not performing as you expected. And the place that I see this the most, at least in terms of financial decisions, is with permanent life insurance. And this is something that we haven't talked about a ton on this podcast for good reason. It is because while there are life insurance policies that have an investment component, I'm not a financial advisor who's okay with pitching a policy as if it's an investment itself. It's a very different thing evaluating how a permanent life insurance policy may fit into a full financial portfolio as compared to the way that you would evaluate a non-qualified brokerage account. But unfortunately, there are some advisors who pitch it as kind of one and the same, or even worse, oh, all you have to do is the life insurance policy. And because you're doing it, you don't need to do those other forms of investments. And I think that's really dangerous because oftentimes when you're comparing a permanent life insurance policy to a more traditional investment, there's a misunderstanding of how one works versus the other. For example, if you put $1,000 into a non-qualified brokerage account, aside from maybe some internal expenses of an index fund or an ETF, you're going to have most of that $1,000 going to your investment. Conversely, with a permanent life insurance policy, you have a policy value or a cash value inside of that policy where your quote unquote investment dollars would go. But there also are insurance costs associated with the fact that it is still a life insurance policy, and the insurance company wants you to compensate them for the risk that you might die, and they have to pay the claim. So, over the course of time, more and more goes to your policy or cash value. But in the first few years, a small amount goes. You may put $2,000 into that policy in a year, and you may have $500 go to your policy value. It gets better over time, but there also are things like surrender charges, where if you were to cancel that policy at some point within the first 10 years, you're not even going to be able to recoup all of the money that you see in your policy value. Does that mean that you should never have a permanent life insurance policy? Absolutely not. I have permanent life insurance, although I would say there's a great number of people who should avoid it. But it does mean that in terms of when you evaluate the mistake, if you're going to it and looking, saying, hey, after 2 or 3 years, I'm going to determine whether this was the right move, you're looking at an investment that is just simply not structured to be able to make an educated and informed decision in that period of time. So, step one, determine when you are going to look back and evaluate whether you've made a mistake. Step two is to determine what constitutes a mistake. What is it about that investment that is going to make you say, ooh, I knew, or I was worried, and this confirmed that this wasn't something that I should have done? And this part of the process speaks to how you evaluate the investment itself, and it's going to change based on what you're evaluating. For example, we talked about making an investment recommendation or an investment management recommendation. And the temptation when you're evaluating an investment is to just simply look and see whether it had positive performance. And that's your indicator of whether it's doing well or not doing well. When in actuality, most investments or investment managers have a benchmark. They have a portion of the market or a composite of the market that they're using to track its performance and compare its performance. For example, if you're looking on screen, there's what we call a fact sheet from an investment called the Vanguard Life Strategy Moderate Growth Fund. This is an index fund that's very popular in the Vanguard umbrella, and it's for moderate investors. As a matter of fact, if you look at the risk level on this fact sheet on a scale of 1 to 5, it's literally a 3 right down the middle. It has a low expense ratio of 0.13%. And you'll see on this page, not only over the course of these 2 pages, the investment strategy, the investment components of this investment, its performance over time, you will also see what it's using as its benchmark, and you'll see the performance relative to said benchmark. For example, the benchmark for the VSMGX fund is the Moderate Growth Composite Index. So that is some compilation of investments that they are going to consider once altogether a moderate investment. It may be that 60% of it is large cap value stocks and 20% is large cap growth stocks, and maybe 10% are treasury bills or international bonds. But whatever portion of the market they're tracking, that's what they're using to evaluate performance. And you can see that performance over time. For example, year to date, the fund itself is up 7.89%, which is higher than the performance of the benchmark, 7.74%. Over the course of 10 years, however, it's basically in lockstep. The fund has performed 7.05, the benchmark 7.36. This is something that you see with a lot of index funds where the performance of the benchmark and the fund are very similar, because the goal of most index funds is not to make a bunch of decisions separate from the index. It's to simply follow it as closely as it possibly can. And this is something that would let me know, hey, this is actually performing as indicated and as intended. So if I'm looking at this investment after, say, 3 years, and I'm upset with the performance, it may be that I have improper expectations and it's actually performing the way that it's intended to perform. It just so happens that it's been a rough few years. Or if I'm looking at it and I'm saying I'm disappointed, maybe I chose the wrong investment for me, and I have the information to go find a different benchmark or a different fund in terms of what it's tracking that suits my risk tolerance. For insurance policies, like we discussed, there are a number of factors that can help you determine whether it's true underperformance of the policy itself or whether it's a broader economic function. For example, there are permanent life insurance policies called variable universal life policies. And in those policies, your cash value is invested in sub-accounts that are very similar to what you would see in like a mutual fund. Well, if you found a policy that's quote unquote underperforming, it may be that you've just chosen the wrong sub-accounts, and you could find different sub-accounts or a different allocation that would perform better, but it doesn't mean that the bones of the policy are poor. There's also index universal life policies where the cash value is tracking the performance of an index like the S&P 500. And maybe it's just that the S&P 500 has had a couple rough years, or it could be that if you think you've chosen the wrong index and there's the opportunity to switch within that policy, that you could do so. But again, the bones of the policy are just fine. On the other hand, there are a number of factors that might say, no, this isn't performing the way that I expected. For example, you have whole life insurance policies where at the beginning of the year, there's going to be a dividend rate that's declared. And that is essentially the interest that's credited to your cash value that's guaranteed for the year ahead by the insurance company. Well, many people will look at the historical dividend rates of a company to make their decision in part as to which whole life policy they'll choose. But if you get into that policy and the rates have changed and they've gone lower and they're much lower than you've expected, and you don't think that they're going to increase in the near future, then you may have to make a decision over when is the time where you fish or cut bait on that policy. Do you wait till the 10th year where the surrender penalty has expired and you can walk away with all of your cash value? Or do you want to get out of it even sooner and not throw more money at the policy with the understanding that it's going to cost you penalty fees to walk away before that first 10 years has expired? With a real estate property, make sure you're bringing the right considerations to the table in the evaluation. If you're upset that the values of the property haven't increased, but it's already a property that you were doing for a long-term rental play, then you may be thinking about the wrong things, right? The value doesn't have to have increased in the first 3 years if in the long term it can still be a profitable rental property. However, if you were trying to flip the property and the values haven't increased, that's a big factor in your decision-making process. And step 3 in the process is determining whether that mistake can be corrected. If it were an investment, maybe you sit in on the quarterly calls where you can hear the mistakes that they feel they may have made or the market forces that have led to underperformance. You'll find the same with an investment management company. And you can decide whether in the long run you agree with their path forward or whether you want to cut bait. With an investment property, if it's a short-term rental, can you increase the rents by having better marketability? If it's a long-term property, are you looking for the wrong type of tenants? Is it because you're paying a property manager too much money, or is it because you have the wrong property manager? If it's costing you more in upkeep, do you have the right maintenance person looking after the property, or do you need to spend some money now that will save you in the long run by getting things like a new hot water heater or a new HVAC unit so you don't have to keep paying for repairs? All of these considerations factor into determining whether it's something that's not working out right now but can work, or whether you've truly made a financial mistake and what comes next is actually fixing a mistake that's been made.
This is the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. We'll be right back.
Are you wondering what new money problems you might be overlooking in your financial life? If so, we've got great news. We've crafted the New Money, New Problems Gap Finder to identify potential weaknesses in your finances in areas ranging from budgeting, investments, insurance, and even the threat your extended family's finances could pose to your household. Please head to newmoneynewproblems.com/gapfinder to complete it today. Again, that's newmoneynewproblems.com/gapfinder to take the assessment.
You're listening to the New Money, New Problems podcast. Subscribe now at newmoneynewproblems.com. Welcome back.
The fourth step only occurs when you've actually made a financial mistake, and that step is determining why you made the mistake in the first place. And this can go back to some mix of investment biases and money disorders like the ones we talked about from the beginning of this episode and this podcast. We had, for our first interview ever, Dr. Ted Klontz, who wrote the book Mind Over Money about financial disorders. He actually doesn't like the term financial disorder, but there are a great many of them that he talks about in his book where there are things that you saw and observed and gleaned as a child that inform how you deal with money as an adult. There's a great number of them. There's financial denial, where you are so stressed out by money that you just act like it doesn't exist. Even if it's burning behind you, you would just rather just avoid it in the first place. There's financial rejection where you have some guilt and shame about the money that you're making or earning, and you find a way to make poor decisions and get it out of your hands. And there's also investment biases. For example, there's overconfidence where you have a higher opinion than you should of your own abilities to analyze an investment. There's confirmation bias where you are ignoring all of the information that's counter to what you think about an investment. There is anchoring where you have a certain price or performance in your mind and you stick in an investment too long because you are trying to get back to that high watermark that you have in your head. There's recency bias. There's herd mentality, which is one we see a lot, where you are just going along with what you heard people say you should invest in and how you should invest. And it leads to negative financial decisions. And then there's loss aversion. Loss aversion can tie into a disorder like excessive loss avoidance, where you've seen something in your early life that makes you so afraid of taking risks that it actually costs you in the long run and makes it more difficult to achieve your financial goals. All of these things can factor into bad decisions. I've talked about and did talk about on the episode that we linked to about my biggest financial mistakes, an investment property in Nashville that my wife and I were trying to purchase. It was $117,500, which, if you know anything about Nashville, that just doesn't exist. And the only reason we didn't get that property is because we didn't have a good enough debt to income ratio. And they said, we will still give you the property if your parents co-sign on it. Now, at the time, I said, no, we have to stand on our own 2 feet. That would be inappropriate to ask my parents to take on that financial burden, even though it wasn't going to cost them anything. We were going to take care of the house. They just had to sign for it. And I didn't do it. And I thought that I was making the right decision. With time and age and wisdom, I look back at my childhood and I can recognize that when I was growing up, the son of a doctor and a realtor who did well, I had to deal with a lot of, oh, those are the rich kids, or they're spoiled, or their parents give them everything. They don't have to work for anything. And while I would like to think that that didn't bother me, I look back and I say there are some positives that came from that, in the sense that I work very hard to make sure I show appreciation for whatever my parents have given me. But on the negative side, there are a lot of things where I have made decisions based on the fact that I just am very uncomfortable with receiving assistance. Going back to that childhood of feeling like if I accept help, it means that I failed or that I can't do something on my own or that they did it for me. And that pride has put me in positions where we've lost tens, if not hundreds of thousands of dollars, at least on those two properties. And that factors into the next step after you've determined why you've made a financial mistake. And that is putting controls and barriers around your behaviors to make sure that it doesn't happen again. So when I get into situations like that, where there are basic forms of assistance that are offered to me, I have to ask myself, am I about to say no because this is truly something that I don't need to accept and can do on my own? Or is there something deeper and more prideful that's keeping me from accepting this form of help? You have to have some self-awareness as to why you made the mistake. And you have to find a way to put controls in place to make sure it doesn't happen again if it was actually a mistake. And that gets to the second to last step in the process, which is determining whether it was truly a mistake or whether things just didn't work out. I cannot tell you how many times I've had this conversation with business owners where a business opportunity doesn't work out, or something that they planned and thought that they went through just didn't work out. And there's always something that you can bring to the table for future decisions. But it does not mean that everything that doesn't work out financially is a result of poor decision making. And I would want you to have an understanding of the difference between the two. But even if you know the difference between the two, the last step is the same for everyone. Get over it and move forward. No matter whether you made a financial mistake or whether it was something that just didn't work out, it's over. There are some things I talk about in the article where, in that example of the rental property, I don't even drive down that street. And it's not because I'm afraid that I'm going to burn the house down or just, break out into tears. It's more so there's a street right over that I can take and get to the same destination. And I don't have to go on that street. I don't have to be reminded of the mistake that I made and have all those negative feelings dredged up. It happened. I know what I did that I don't want to do in the future, and I'm moving forward. And you need to do the same. If you're a couple and your spouse or your partner keeps bringing up the financial mistake, you need to let them know this is not instructive. We've talked about it. We've determined what we did wrong or what I did wrong, and we're going to move forward and not have this be the thing that dominates our thinking. Because the good thing is, if you're here listening to this episode, it means you're in a position to make better decisions moving forward, and dwelling on what happened in the past is not a part of making that next step. I'll see you next week.
From New Money, New Problems, this was the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen.